Welcome, everybody, to a new episode of Crashes and Taxes. I'm so excited to bring you into the new year 2021 and to have said goodbye forever to 2020. I've never been so excited to get rid of a year in my adult lifetime. Wow, what a year. Absolutely crazy year that we had. And it really brought me to want to just cover a basic topic with you, which is what kind of risk can we actually get rid of? So for those of you that are loyal listeners to Crashes and Taxes, let me first apologize. I want to explain what's going on and why Crashes and Taxes hasn't been something that I've updated in just a little bit. So if you're watching the video podcast, hi. If you're on sound only, audio only, working out, thanks for taking me on your workout. And let me just say why I haven't had an update in a little bit. First of all, we have really grown. Our team has expanded quite substantially this year, and we've got a lot of growing pains the last 2 months of the year with our practice with our clients. So let me apologize for sort of being super inundated with that. The other thing that has happened that is now actually started is I am in the class of 2022 for the London School of Economics, the NYU, New York University, and a school out of Paris called HEC. These are 3 of the top business programs in the world. They've combined to globally produce a global executive MBA program through the London School of Economics. And I am and have joined that program as of this fall, which has started in earnest. So the reasons that I have been sort of inundated is my practice is exploding, and more so than even normal. And so we had a lot of growing pains. And then I've now started the executive MBA program, which I'm doing completely on my free time. But it just means that I just haven't had as much time. But we have got all this worked out now going forward, and so we should be religiously giving you a new Crashes and Taxes every single week. So what is it that I want to talk to you about today that I think is just a great basic lessons to start with for 2021? And it's really about market risk. And so what you need to understand when you are looking at a portfolio is that every stock has its own inherent risk, or every equity position you might hold has its own inherent risk. And so let's say, for example, that I am in China and I am a Chinese quasi-government, quasi-private corporation, as the Chinese communist model is and allows and provides for. And I want to sell shoes in China. And I start selling shoes in China, and I become one of the big shoe providers of China. Well, if I'm in China and I want to invest, or if I'm even in America and I want to invest in international stock, I might say, I think this shoe company in China is a great investment. I want to buy them. But along with any other risk, China very specific, very unique, being the CCP, the Chinese Communist Party, as in control of not only their government but also their economy. There's a risk to that Chinese shoe company that China might just come along and say, you're no longer allowed to do business in China. We take away your license. So there is a risk to investing in a Chinese stock that is specific to that stock. And this is the case across the board. And we've just identified that in China, the risk is related to the fact that the CCP, the Chinese Communist Party, controls not only the government, but also the economy. And that's the definition of their party, obviously, as we know. And so that's a risk, that's a political risk that's specific to that stock that is being bought in China. If we look at an American company, let's look at Apple. And let's say Apple is now very clearly a MNC, a multinational corporation. They were based in Ireland for tax reasons. With Apple's new frontier is China, right? They want to sell apples to all 1.4 billion Chinese. Now, Huawei is going to have a problem with that. You've heard about Huawei, and you've heard about, and people pronounce it differently. I pronounce it Huawei. The problem with Apple is that they have a very big competitor, not only in Sony and Google and Android and those operating systems, but they also have a very big competitor with Yahoo, which is obviously Chinese based. And they have also ZTO. So Apple has, as a multinational US based but multinational corporation, along with many US corporations and most MNCs, have moved beyond just America. They're not just looking at America's economy. They're really looking at international opportunities, specifically India and China, where obviously the two most populous, densely populated countries in the world, over 1 billion people each. China just slightly edges over India by about 100,000 people. So you've got, about 100 million people rather, because we're talking about billions. You've got huge frontiers for multinational corporations that are outside of the United States. And so this is very much happening. So when I look at Apple as a potential stock holding, I don't just look at Apple and its prospects in America and how saturated earbuds are, iPhones are, their new music subscription-based service. The Apple has got so much you would not even believe unless you really understood Apple and how their revenue model really works. Apple TV, subscription-based services, all of their control over apps on smartphones that they get royalties and revenues from is so much. This is why you've seen some Apple litigation with some app companies this year in 2020 because of their control and almost you could almost say monopoly, although it's not, because there's obviously a huge competitor in the US, which is the Google Android phone. So these are the concerns that we have with Apple. Just understand that most multinational corporations that are U.S. based or U.S. started now are much more looking beyond the U.S. and beyond what the U.S. offers and looking more to the new frontiers of India and China as to where their markets will go in the next 10 years, decade or two. And I point all this out to you because I want you to understand that if I buy Apple directly, I cannot get away from that risk that is to Apple and the risk of economic future possibility with what they're competing with and where they're at and litigation that they may have or not. Another really great example is Uber and Lyft. When Uber IPO'd, they obviously let us know that one of their biggest risks that they are undertaking is the fact that they could be at any time reclassified as workers, employees, W-2 workers as opposed to independent contractors, and that would absolutely kill their business model. And so when they IPO'd and we're talking now about disclosures they have to make, they made a disclosure that they had already lost at the UK Supreme Court level and that it looked like that the UK is going to make them reclassify their workers as employees, which kills their business model. Now, Lyft is much more US based, Uber is much more international based, but this is just a risk that is based specifically on that stock. When you pick stocks, it takes about 20 stocks to diversify, and you need to get 20 stocks that are non-correlated. So what that means is two stocks that would not be correlated would be, for example, great example would be if I'm buying a utility-based stock. Let's just use I can't even think of a utility-based stock right now off the top of my head. Let's just use AT&T. It's kind of more of like a legacy cell phone provider, DirecTV that they're spinning off, all these things. So let's just pick AT&T as kind of like a solid dividend payer, right? So we're going to buy AT&T for their great dividends, one of the best dividends available. So we're going to buy AT&T for dividends, but we want something else that's not an AT&T or a utility-based stock. We want a growth stock. So maybe we're going to buy, because we think there's pent-up demand after 2020 shutdown from coronavirus, maybe we're going to go out and buy Carnival Cruise Lines, which is really, cut and gutted from the 2020 results. And so we're going to buy into Carnival while it's still down. Well, Carnival Cruise Lines and AT&T are probably very non-correlated. In other words, people need cell phones and they need DirecTV and they need cell phone service and they need maybe even, legacy phone service. I don't know. They have a global, AT&T still offers global networking capabilities and all kinds of things. So that's more of a utility type of stock that people need regardless of the economic situation, whereas Carnival is 100% going to be based off of demand and it's going to be gutted like it has been when there is no demand for travel. These are non-correlated positions, and as the market does well, Carnival might do great, and people might not be buying as much of AT&T because they're looking at more flashy things. So these are two non-correlated stocks, and you can really start to diversify away your individual stock risk by owning a portfolio of stocks. And so that magic sweet spot is about 30 stock positions. If you have about 30 stock positions, you've pretty much, as long as you're buying non-correlated assets, you can't buy AT&T and Verizon and another phone carrier and think that, oh, I'm diversified. We're talking about buying 30 stocks at least that are in non-correlated sectors. So across the breadth of the economy and of the market, you can diversify away individual stock risk almost to the point that it's non-existent. And it's about 30 stocks. You could get a little bit more diversification with up to 40. Beyond 40, there's no real additional diversification as long as you've bought non-correlated stocks in non-related sectors and industries. So that is what people and financial advisors are talking about when they talk about diversification. They're really talking about what ability do financial analysts and financial professionals have to get rid of, through diversification, the specific risk that is attributable to the economic fundamentals that are affecting that particular stock. We can almost virtually eliminate that risk through diversification. So what you've seen that's come up about over the last, I'd say, 4 decades is people have become educated about this and they think, okay, I just need a stock portfolio of 30 to 40 positions and I'm golden. But they miss the whole second part of this lesson. Diversification only diversifies one type of market risk, and that is specific market risk. In other words, we can almost virtually completely eliminate the risk of owning any one particular stock because we diversified its risk through a plethora of other non-correlated stocks. But we have zero, and I mean literally zero ability to diversify away market risk, or what we call systemic risk. In other words, all equity investments are inherently come with risk. They are inherently risky. And as much as we want to diversify away risk, which we can do of specific companies through diversification, we can do nothing to diversify away the risk of the market itself crashing. So what kind of crashes am I talking about? The Great Depression of the late 20s, early 30s. Systemic market risk. Everything collapsed. We had a run on the banks. It was the worst ever. We would have been there this year with 2020 if we hadn't had $6 trillion of money pumped in from the Federal Reserve and Congress. So the Great Depression. Black Monday, October of 87. A crash of the S&P and the market in one day, massive crash. That is a market crash. Cannot diversify away from that. The entire market crashed down in one day. Dot-com crash, late 90s, early 2000s, 3-year correction, 49% down S&P 500. Great Recession crash, 18-month correction, 57% down. Entire market went down. Coronavirus crash, February 19th, March 23rd. Market went down 34% in 5 weeks. This is the kind of risk that is not diversifiable. You cannot diversify it. So what do? Well, what you do is you work with a financial advisor who says, we cannot have every dollar you have in the market. We have to have an alternative asset class that is not going to give or involve the risk of the market, so that when the market does go down, we do a great job at our firm of minimizing and mitigating the downside. But when the market does go down, because it's not controllable, we must accept there is risk. We have another alternative money bucket to go to, alternative strategy outside of the market that is not crashed down, that we can then live off of and give our market portfolio room to breathe, recover. Because the last thing we want to do is break the golden rule of do not take money out of a down portfolio. You lock in forever your losses. We want to give ourselves the opportunity to grow that money back. So just understand at this very beginning of 2021, as you're building out a plan for the rest of the year, if you're thinking, well, I can pretty much diversify away all this risk, you can diversify away the risk of equities in a very well-balanced portfolio of at least 30 stock positions or greater. Beyond 40 is really, there's no additional mathematical benefit for diversification beyond 40 positions. Really 30, but 40, I would say, would be the most. But beyond that, the market is something that we cannot tame, we cannot control. And I'll give you an example. I mean, everybody thinks of Warren Buffett as the most prolific investor of all time. But two of the crashes I just mentioned, the dot-com crash, the S&P went down 49%. Warren Buffett's Berkshire Hathaway went down 48%, the exact same time period. This is Warren Buffett. You look at the S&P 500, the Great Recession, the S&P went down 57%. Warren Buffett's Berkshire Hathaway went down 50.7%. So he didn't do as bad. He shaved off about 7% of the loss, but still went down 50.7%. So even Warren Buffett knows that we cannot diversify away the risk of the market itself. And the market itself goes through cycles. The market is cyclical. If you look at the last 30 years, we have a 10-year bull market at the beginning from 1990 to 2000. We have a 10-year bull market, almost 11 years from 2009 through 2019. We missed it by 1 month, an 11-year expansion. We missed it by literally 1 month. We had 131 months of expansion. And the 10 years in between, we had the 10-year period of volatility, which we call a lost decade. So, and you're looking at patterns, I would expect 2020 to 2030 from a pattern perspective to follow a pattern of volatility, great volatility. When you overlay what 2020, 2030 is going to be from a pattern perspective, and you overlay what's happening with the retirement of the boomers, 65 million boomers still working that are going to retire fully and go on Social Security and Medicare, which is a whole nother separate talk, then you know that you should expect to be prepared for volatility. And when you prepare for volatility, just understand that diversification that people talk about only gets rid of specific individual stock risk. We cannot diversify away the risk of the market, which is why we use other asset classes beyond just the market to really build a true financial plan. So I want to wish you a very happy 2021. Thank God 2020 is behind us. This is going to be a tremendous year for opportunities. If you see them and you take them, it's going to be a tremendous year of opportunities. So I want to wish you all a very wonderful, happy, safe New Year 2021. And I look forward to being with you every week from now until then. Thank you so much. God bless.